60, and silver printed a one-day fall of about 31%. Those are not the kinds of numbers people associate with safe haven metals. They are the kinds of numbers that usually belong to flash crashes, broken plumbing, or forced liquidations that leave traders staring at screens asking how something so stable could move like a meme stock. And yet it happened anyway. Or they said liquidity is deeper now. They said the circuit breakers, the risk models, the clearinghouses, the algorithms, all of it. But the tape just delivered a message that's brutally simple. When positioning gets crowded and the rules of collateral shift under everyone's feet, even the calmest markets can flip into violence in hours, not months, not weeks, in 48 hours. By the time a move like that shows up on your phone, the institutions already know why it happened, because many of them are wired directly into the mechanics that cause it. They see the margin schedules before the crowd reads the headline. They see the flows through futures, options, and funding channels. They can tell when a sell-off is fear and when it's math. What I'm about to reveal changes how this entire move looks, not as a simple strong dollar story, but as a pattern. A market that was stretched, then hit with a mechanical accelerant, then forced to welcome to signal before headlines, where we decode what matters before it becomes the story everyone repeats. If you like analysis that follows data, plumbing, and incentives instead of noise, settle in. And as you listen, drop a comment with where you're watching from, because these moves aren't just charts on a screen. They're global signals that ripple through every economy. Now let's reconstruct what happened with forensic detail. On February 2nd, 2026, markets woke up to a classic cocktail. Shifting expectations around the Federal Reserve, a firmer dollar, and an unwind across crowded trades. The trigger in headlines was the idea that Kevin Warsh could be in line for the next Fed chair, a narrative that pulled rate expectations in a more hawkish direction and pushed the dollar higher. When the dollar strengthens quickly, it tightens financial conditions and pressures dollar-priced commodities. That's the textbook explanation. The abnormality wasn't just direction, it was speed and magnitude. Gold had been trading near record highs, and then it fell nearly $1,000 off the top. Silver, which is famously more volatile than gold, didn't just drift lower, it collapsed in a single. That's where the mystery starts. If this were simply a macro story about rates and the dollar, you would expect a grinding adjustment, not a trapdoor. You would expect a repricing over days, not a cliff that forces liquidation across the entire complex. To find that answer, you have to stop staring at the price and start staring at the rules that govern the trade. In January 2026, CME Group changed the way it sets margins on precious metals futures, effective January 13, 2026. The new methodology moved margins toward a percentage of notional framework. That sounds boring. It isn't. It means that as prices rise, the collateral required to hold positions rises automatically because notional value rises, force selling into weakness. The dollar doesn't issue margin calls. Clearinghouses do, and margin is where calm turns violent. To understand why, we need to look at history, because this isn't the first time metals have gone from orderly to chaotic overnight. The playbook is older than the modern electronic market, and it repeats because human incentives and risk constraints repeat. In 1980, silver became the symbol of a market that had run too far, too fast. The combination of speculation, leverage, and tightening rules produced a dramatic reversal. The details differ across decades, but the mechanism rhymes. Leverage builds in a rising market. Rules tighten or collateral demands jump, forced selling cascades, and the public sees the crash as mysterious because they weren't watching the plumbing. In 2011, silver again delivered a lesson in how exchanges and margin can accelerate a reversal. The price surged and then fell sharply as margin requirements rose and speculative positioning unwound. The market didn't crash because everyone suddenly decided silver was worthless. It crashed because leverage becomes fragile when the cost to carry it changes. In 2020, even gold saw moments where liquidity disappeared and spreads widened in assets considered deep. The lesson was that liquid is not a permanent state. It is a condition that exists when counterparties are willing and able to make markets. When collateral becomes scarce or risk limits are hit, liquidity evaporates. And now in 2026, the same pattern is flashing again. An extended move, crowded positioning, and a collateral regime that can tighten automatically as notional rises. The story isn't just about retail traders or speculators getting too excited. The structure of the futures market itself shows the tension between speculators and commercials, and that tension matters because it reveals who is leaning which way when the floor drops. As of January 27, 2026, COMEX gold open interest was about 463 contracts. Non-commercial traders, the category that often represents funds and speculators, held around 251,100 long contracts against roughly 46,704 short. Commercial participants, often producers, merchants, processors, and swap dealers, showed a very different profile. about 344,485 short contracts against about 96,200 long. In COMEX silver, as of January 27, 2026, open interest was about 156,637 contracts. Commercials were short around 88,144 contracts, and long around 44,788. Non-commercials were long around 49,531, short around 25,575. Those numbers don't predict anything by themselves, but they tell you the market was positioned with a lot of speculative length, while commercials carried heavy short exposure that often reflects hedging and market-making activity. So when prices lurch, who feels the pain first? Often, it's the leverage side that has to meet margin calls, not the side that is naturally hedged or structurally financed. Now bring that back to the margin methodology change. When margin is set as a percentage of notional, a run-up in price increases the notional value of open positions. That raises required collateral. If a trader is long futures, they can be right on direction and still be forced to liquidate if their cash management can't keep up with rising collateral demands. That's how bull markets end abruptly, not because the thesis collapses, but because the financing does. Think of it like this. You can own a house in a rising neighborhood, but if the bank suddenly demands a much bigger down payment overnight, you might have to sell the house even if the neighborhood is still improving. The asset didn't change. The terms changed. That is the mechanical accelerant. Now layer in the macro impulse. A stronger dollar and shifting Fed expectations tighten the screws. Volatility rises. Risk managers demand reductions. Funds de-risk. The same positions that were profitable in the rally become a source of risk in the reversal. And because so many participants are leaning the same way, they all try to exit through the same doorway. That's when the calm breaks. But the deepest clue that this is not just another pullback is the dislocation between different signals. The paper price action screamed liquidation and panic. Yet structural demand signals in the background have been flashing persistence. Consider central bank demand, 3 tons in 2025. That's not a day trader phenomenon. That's a multi-year strategic behavior by institutions that think in decades, not weeks. And even if those numbers shift month to month, the message is clear. There has been a sustained official sector bid. So how do you reconcile a violent paper reversal with a persistent structural buyer? You reconcile it by realizing they operate on different time horizons and through different channels. The paper market reprices quickly because it is leveraged and mark to market. The structural buyer accumulates through programs and reserves, and it is less sensitive to daily volatility. When those two worlds collide, you get air pockets in price discovery. This is the evidence chain, and it matters. 60 and silver down about 31% in a single day. Second, we have the timing. February 2nd, 2026 was the inflection point where macro narrative and collateral mechanics converged. Third, we have the rule change. The CME margin methodology adjustment effective January 13th, 2026, shifting toward percentage of notional margins. Fourth, we have the positioning backdrop, January 27th, 2026. CFTC data showing large non-commercial length in gold and notable commercial short exposure in both gold and silver. Fifth, we have the structural demand backdrop, central bank buying measured in hundreds of tons over 2024 and 2025. Put those together and the picture changes. The move becomes less like a random shock and more like a reset. Now let's talk about the players, because markets don't move on numbers alone. They move on who is forced to act, who is protected, and who is opportunistic when others are trapped. Start with the exchange and the clearing system. CME Group is not a villain or a hero. It is a risk manager. Its job is to ensure contracts clear, that defaults don't cascade, and that margin levels reflect volatility. When it adjusts methodology, it changes the leverage available to the entire market. That's power, even if it's technical. Then you have the funds. Large macro funds, trend followers, and commodity-linked strategies often use futures because they are capital efficient. Capital efficiency is another word for leverage. Leverage amplifies gains, but it also makes you vulnerable to margin calls. When the carry cost rises, or when volatility spikes, leverage becomes a liability. Then you have the commercial side. Miners, refiners, bullion banks, swap dealers, and merchants who use futures for hedging or inventory management. Their position profile can look net short because they are hedging future production or providing liquidity. They may have different financing structures, different balance sheet access, and different risk horizons. Then you have official actors, not in the sense of daily trading, but in the sense of policy expectations. When the market reprices the Fed path, it reprices everything connected to real yields and the dollar. Even the rumor of a different policy regime can tighten the market. And finally, you have the public narrative machine. It arrives late. It takes a complex mechanical event and compresses it into a headline that fits in one sentence. That's why so many people are confused. They are reading the headline about a stronger dollar while the real story is about leverage meeting a new margin regime in a crowded trade. This is where coordination appears without needing conspiracy. It's timing, it's incentives, it's the way risk systems react at the same time across institutions. When volatility rises, VAR models spike. When VAR spikes, risk limits shrink. When limits shrink, positions get cut. When positions get cut, prices fall. When prices fall, margins rise relative to equity. When margins rise, more positions get cut. The feedback loop is coordination by mathematics. Now let's focus on the dislocation, because this is where the calm before a violent reversal becomes actionable as analysis, not advice, but understanding. There are two markets in precious metals that often send different signals: the paper market of futures and derivatives, and the physical market of bars, coins, and vault inventories. The paper market can expand and contract in notional exposure far beyond physical turnover, because it's about financial exposure. The physical market moves slower, constrained by logistics and fabrication. When paper prices crash, physical premiums can behave differently. Sometimes physical demand surges as buyers see lower prices. Sometimes dealers widen spreads due to volatility. The point is not to claim a shortage or make sensational statements. The point is to recognize that paper can overshoot in both directions because it is leveraged and forced. Another dislocation is geographic. Western price discovery tends to be centered on futures exchanges and OTC markets. Eastern demand can be driven by jewelry, savings behavior, and local currency dynamics. When the dollar rises, some local currencies weaken, and local buyers may behave differently than Western speculators. A third dislocation is between official narratives and balance sheet reality. When real yields rise, gold often faces headwinds. But when debt levels, fiscal uncertainty, and reserve diversification are in the background, gold can retain a structural bid even through drawdowns. Those forces can coexist. So when you see a violent reversal, you ask a different question. Is this a fundamental repricing of long-term demand or a mechanical liquidation within a longer-term regime? The data suggests it is primarily the second, and this is the mechanism that executed it. Step 1. A rally builds. Momentum funds and speculative flows add length. Open interest grows. Volatility is manageable, so leverage feels safe. Margin requirements, as a percentage of account equity, feel tolerable. Step 2. The collateral framework tightens as prices rise. Under a notional-based methodology, rising prices can raise required cash. That doesn't force selling immediately, but it reduces the cushion. Step 3. A macro impulse hits. A stronger dollar, shifting Fed expectations, and a risk-off move raises volatility. The market moves against the crowded position. Step 4. Margin calls and risk limits trigger. Participants need cash. They sell what they can, not what they want to. Liquid positions get liquidated. That selling pushes prices lower. Step 5. The feedback loop accelerates. Falling prices create losses. Losses reduce equity. Reduced equity makes margin a larger percentage of remaining equity, and more selling follows. Liquidity providers step back. Spreads widen. The move becomes violent. This is why the reversal feels like it comes out of nowhere. It doesn't come out of nowhere. It comes out of the mathematics of leverage under stress. Now, what does this mean going forward? Historically, when metals experience a leverage-driven liquidation after an extended run, one of three paths tends to follow. In a conservative scenario, the market stabilizes, volatility compresses, and prices chop as positions reset. Open interest declines. The most leveraged participants are cleared out, and the market rebuilds on a more stable base. In a moderate scenario, the first liquidation is followed by a relief rally, then another bout of volatility as the market tests whether demand is real or only financial. This is where many get whipsawed, because the tape alternates between fear and hope. In a more aggressive scenario, dislocations persist, and the market experiences repeated spikes in volatility as collateral and liquidity constraints remain tight. The key is that this doesn't require any grand narrative. It requires only that funding conditions stay restrictive and that positioning continues to swing. Instead of predicting, watch indicators that reveal which path is unfolding. Watch the dollar trend, because it pressures commodities. Watch real yield expectations, because they influence opportunity cost. Watch measures of volatility, because margin is a function of volatility. And watch open interest and positioning, because crowded trades break differently than balanced ones. If open interest collapses while prices stabilize, that suggests the liquidation phase is doing its work. If open interest stays high and volatility remains elevated, that suggests the market is still fragile. Now we arrive at the divide. There are two groups that experience events like this differently. The first group watches the headline and reacts emotionally to the price. The second group watches the mechanics and understands why the price moved before the headline explains it. This isn't about being smarter. It's about paying attention to the parts of the market most people never learn. Margin methodology, clearinghouse incentives, positioning reports, funding conditions. Those details sound boring until they decide whether a market moves 5% or 30%. The information gap becomes a wealth gap, not because anyone is evil, but because institutions invest in understanding structure, and the public is trained to consume narratives. Institutions move first because their systems force them to respond first. Retail moves last because they react to the story after the move is already done. That's why this moment matters. The calm before a violent reversal isn't a mystical warning. It's a description of what happens when leverage, rules, and crowding align. The metal itself doesn't change overnight. The terms of holding it do. This is signal before headlines, where we decode what matters before it becomes the headlines. If this connected dots you hadn't seen, you know what to do. And remember, the question isn't whether markets will swing. The question is whether you understand the mechanism while the swing is still forming. Before we finish, there's one more layer that turns this from a dramatic chart into a clear mechanical story. Futures contracts are big by design. A standard COMEX gold contract represents 100 troy ounces. A standard COMEX silver contract represents 5,000 troy ounces. At a gold price above $5,000 per ounce, one contract controls more than $500,000 of notional exposure. At a silver price around $40 per ounce, one contract controls roughly $200,000 of notional exposure. These are instruments built for institutions, hedgers, and professional risk systems, which is why small changes in rules can have outsized impact. If gold moves 2% on $500,000 of notional, that's about $10,000 per contract. If silver moves 5% on $200,000 of notional, that's about $10,000 per contract as well. Stack a portfolio of dozens or hundreds of contracts, and the daily variation margin can become an immediate liquidity event. That is why being right is not enough in a leveraged market. The timeline of cash matters as much as the thesis. Now connect that to the January 13th, 2026 shift toward percentage of notional margining. When notional rises, required collateral rises. That means a rally can quietly tighten the system by draining cash into margin accounts. Then, when the reversal begins, the same participants have less free cash available to absorb losses. In plain language, the market can feel fine right up until the moment it doesn't, because the stress is building in collateral, not in headlines. This is also why you can see a sharp fall even while longer-term demand remains intact. The futures market is the arena where leveraged exposure gets repriced fastest. The physical market, central bank programs, and long-horizon allocation decisions don't flip in a day. They don't need to. They operate on schedules, committees, procurement cycles, and reserve frameworks. Once you frame it that way, the phrase calm before a violent reversal becomes less mystical and more practical. Calm often means the market has become one-sided, and volatility has been suppressed long enough for leverage to accumulate. Violent reversal is what happens when something changes the cost of holding that leverage, whether it's a spike in volatility, a surge in the dollar, or a tightening of margins. So the real question is not whether gold and silver can fall. They can, and they just did. The real question is what happens after the leverage is purged. Does volatility fade and allow a base to form, or does funding stay tight and keep the market fragile? Watch the indicators that reflect stress, volatility, open interest, and the speed of dollar moves. When those stabilize, the market often stops behaving like a trapdoor and starts behaving like a market again. Until then, treat every calm patch with respect. Because in markets, calm is sometimes peace, and sometimes it's pressure, and notice how the biggest moves tend to cluster around moments when everyone is looking somewhere else. When price is rising smoothly, risk models relax. When price is stable, leverage quietly increases. When the first crack appears, the same models tighten all at once. That is why the first down leg can be the most violent. It is not a vote on value. It's a scramble for balance sheet. After that scramble, the market can finally reveal what real demand looks like. That is when the move stops being forced and becomes chosen.